Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for August 18th of 2024. Start off the chart pack this week with a bunch of data that we got over the last week. A lot of inflation data, as a matter of fact, and we'll start off here with the Consumer Price Index. The monthly data, so this is month over month, and you can see that pretty much in line on both the headline as well as the core index. So we've got here we were up 0.2% here, as well as on the core side. You can see in rough terms a deceleration on a monthly basis, more clearly defined, delineated here on the core side. Here's our year-over-year change. You can see in the dark blue line that represents the trend line here. July ended up at about 3.2%. And now if we turn that into a 3-month annualized rate, that number is actually 1.6. And so 2% highlighted here is our target. The Fed seems to be achieving its goal of maintaining price stability, is drawing these prices down over time, as well as managing the full employment side of it, which we clearly know labor is slowing a little bit there. So it seems like they're handling their mandate. I think this gives the Fed plenty of cover. These types of trend lines give them plenty of cover to reduce rates here at their next meeting, and potentially another meeting here left beyond that before the end of the year. Here we have core goods prices, which we know have been largely in decline for the most part over the last handful of months. So goods inflation peaked during 2021. That was a period in which we had those supply chain disruptions. That has pretty much mitigated and since been replaced by services inflation, which we know has been relatively sticky. So now the odd thing here is that we did see a spike in services inflation, up 0.3%, whereas core goods prices were actually down 0.3%. And so we did have a bit of an offset. Something here that I don't think is habit forming, maybe due to some one-off factors there, but we'll have to wait and see. We did have a hurricane that might have impacted that a little bit. So within the consumer price sphere here, we've been talking a lot about rents, and rents and wages are really sticky. And so we've been monitoring the progress in both of these categories. And we have some rent data here. So on the left-hand side, we've got the monthly data in the rent of primary residence, and that was up about 0.5 percentage point, which a bit of a surprise here. We saw a spike. We've been watching this downtrend for many months now, and so we had this odd spike, and you could see both in the rent of primary residence and the OER equivalent, which is slightly different calculation, but that's it was up 0.4%. So again, maybe belies a little bit of the trend line that we've been watching. However, we do see here, if we slide over the right, we've got Zillow's observed rent index month over month, and they advanced this by 17 months to kind of foreshadow where this data might go. And so this in the green and the black represent the numbers here on the left-hand side. But this blue line here, this aqua line, represents observed rents in the marketplace. And we can see that they clearly have come down quite a bit. And so my expectation is that even though these numbers might have spiked a little bit, that it's going to follow this general trend line. We're going to continue to see kind of extended disinflation in the rent sector. So now we'll turn our attention to producer prices. And we have here the PPI on a monthly basis. And just as we saw with the consumer price index, the CPI data, it really was good data. And in this case, it was better than expected. The CPI case, it came in line with expectations here. You can see here the headline producer price index number survey was looking for up 0.2, and we got up 0.1%. You can see that producer prices have not been a huge factor. You get as many months as they're down as they are up. This is only slightly up, so this is much better than expected. And then if you go back to 2021, producer prices, as we know, influenced by supply chain issues, and I mean, goods prices overall were a big driver of inflation, and that's gone away. And then we did see a bit of a resurgence, and that gave us a little cause for, concern. May be a real strong word, but something that we had to follow to make sure that it wasn't going back up. And obviously, in this case, the data came in very, very light, and this shows slightly negative. The headline number, if you round it up, is essentially flat, but it was just ever so slightly negative, but really, really good data. So within the PPI data, the service in inflation here for trade services was actually negative quite a bit. We do know that that maybe this was influenced a little bit by Hurricane Beryl, but not quite sure how much of it yet. I don't know that analysis has been done. This data has been quite a bit noisy over, say, the last couple of years. It is odd to see this, but this is very helpful in terms of its overall impact on the PPI, because it was down 1.3%. Talk about small business optimism. The NFIB, the National Federation of Independent Business, represents small businesses. And I think the takeaway here is actually relatively positive. And there's a different dynamic at work with small businesses than the ones that you read about that are large publicly traded firms. And so small businesses are much more impacted by access to capital and cost of capital. They tend to be more influenced by credit cycles and things like that. You can see the overall optimism index is moving higher. It was actually a little bit better than expected in the July reading. And we look at outlook for general business conditions. This is a diffusion index. So, it's still a bit guarded and cautious, but it's come up quite a bit. And so what you see is basically small businesses are feeling better about their circumstances, but they're still very guarded. And then we slide over here, we talk about small business sales, and you've got the heavy black line here represents actual sales. And you can see really over the last couple of years that this number has trended down. And so this is another diffusion index, so it's a net percentage. And so when you're negative, that just means that that there are more companies, small businesses out there that are maybe less confident about their prospects than there are people, small businesses that are. And so, but this data seems to be slowing a little bit, which gives me a lot more comfort, considering that these numbers are on the way up here. That not to say that small businesses is going to be rocking and rolling, but just that the environment's a little bit better than it has been. Here we have a small business optimism index for sales that still remains fairly negative. But I think what the read through on this is that small businesses are just being cautious. They're expecting interest rate cuts, so their optimism is going up. They're not making large capital expenditures because they don't know what the environment's going to look like, and everyone's kind of postulating over, okay, is this symptomatic of a slowdown? Are we going to have a slower economy in 2025 versus 2024? And it's just keeping the small businesses on guard because they don't have the resources and the financial, backbone that a lot of these large companies do. Talk about retail sales. Retail sales came in much higher than expected. We're looking at 0.4%. We came in a full percentage point. We did have a benefit from motor vehicle sales in total, and so but you also had contribution from a lot of other important areas that you can see here, and the offsets, sporting goods, it's kind of interesting in a summer month, but and then miscellaneous store retailers. But you can see this stands out quite a bit. Looking back, you've got to go back to essentially January of 2023 to see a number as strong as we did this time around. We talk about recession fears and what are the indicators, and there are a lot of different indicators, and this is but one. If we look on the left-hand side, so this is basically the percentage of U.S. states that are seeing significant rises in new jobless claims. And there is a pretty good relationship here that tends to be correlated with recessions. And so this data comes to us from Macrobond as reported by Bloomberg. Here's your recession threshold as they define it. And so, clearly in these instances where it's spiked above it, we've had recessions. What you can't see here in this very, very thin line is a recession related to the pandemic. But yes, we did eclipse that. And this has so far proven to be a false positive. And, when you look at the percentage of U.S. states with really significant jobless claims, that number's really dropped off. In fact, it's really not significant. And so by this measure, there are few signs of a near-term recession in the U.S. And I think that's corroborated by other data, even though it is apparent that there are aspects of the economy that are slowing down. And the other read-through here on, talking about, jobless claims, but, we talk about layoffs here. Challenger Gray measures like large company layoffs, and that's in the green line. And so that's dropping off. And then you've got the share of Russell 3000 firms that are discussing layoffs in their earnings calls. And you would expect there to be some correlation, and there certainly is, but even that's dropping off. So that's not saying that people are out there hiring a lot of new people. It's just saying that they're not necessarily laying off as many. And so, to me, that kind of feels like, okay, the labor market is maybe stabilizing at a lower level than where it was. Labor was really tight and maybe it's softening up a bit, but the fact that you're not, you have fewer companies that are being prompted to lay off people it gives me some comfort of knowing that maybe we might be settling out here a little bit. Here we have manufacturing production. We've talked a lot about manufacturing having gone through a recession of sorts, which it did, but that data seems to be kind of like settling in at a level, a fairly consistent level. If you look at the regional Fed surveys, and this is basically asking companies about prices paid for input costs, and this is prices received for goods sold. And you can see that there's been a fair amount of stability here over, call it basically about the last year. At the same time that you've had manufacturing production overall, be with some exceptions, but be fairly static as well. So this is another good sign for the overall health of the economy. Here we have some commodities data. So we talk about the NYMEX gasoline futures price, and that's in the black line. We see the AAA retail gasoline price in the purple line. As you would suspect, there is a pretty good relationship between these two data series, and they're both coming down. So as we exit the summer driving season, we should get some relief on gasoline prices at the pump. Interestingly enough, and we'll talk about this in the housing update here coming up, that we got lumber prices that have dropped off quite a bit, and now they're coming back up, but they're well below the levels that they were in 2023. So it would be interesting to watch that because the housing data is pretty weak right now. And then also iron ore futures are down in large part because we've got a surplus of Chinese production capacity. And as we'll see a little bit later in our China chart, that we've got a fairly dramatic decline in new housing construction and overall construction. So China's built a lot of capacity in steel production, and obviously iron ore is an input into that. And so as a result, there's kind of a glut, and so that's driving these future prices down. So this chart shows you the Cass freight numbers, and so some interesting takeaways here too. So if you look at overall freight shipments, those have been in decline for well over a year now, call it about a year and a half. But the rate of decline has gone down quite a bit. You can see that in the arrow. Same thing goes for freight rates too. So we had obviously a big spike in freight rates. We talked about that a lot, driving up producer inflation for a while, and then that went down quite a bit, and we could see that those declines were fairly dramatic, and now those declines are attenuating too. So you can see here that you've got freight rates that are not in necessarily in decline. They're kind of settling out at the same time that you've got shipments that are kind of attenuating their decline too. So again, more net, more support for kind of like net. What am I trying to say? Well, basically, it's supportive of economic growth even at lower levels. So we have some data here from the Federal Reserve of Dallas, the Federal Reserve Bank of Dallas, and this kind of breaks out the activity between community banks and regional banks. And if you think about community banks, just kind of like community banks equals small, regional banks equals mid-size. And so, and then you tend to see the fact that more regional banks are publicly traded, so they have to answer to shareholders, and so that data is very visible, observable, and is easily scrutinized. And so I think what we're seeing here, both for the most part on a national and state level, you see those regional banks that are in the light blue are a little bit more conservative on overall loan growth. You can see community banks are really strong in loan growth. And even on the national level, you've got, community banks that are stronger than the regional banks on loan growth, but it's very much pronounced in Texas. And when you talk about asset growth, same deal in both levels, at the state and the national level too. When it comes to deposits, it's also a very similar circumstance. So you've got the community banks that are adding a lot of deposits here, and which is an interesting dynamic. Regional banks, going back to the 2023 bank stress episode, this is just another euphemism of saying the Silicon Valley bank failure, that going back basically about 18 months that you've seen regional banks have had kind of a net flight of deposits. And we've known that, but oddly enough, we've seen those community banks in Texas generate a lot of deposit growth. So very interesting data here from the Dallas Fed on the health of the community banking sector. And as we have been talking about the prospects of lower interest rates, and I think the inflation data this past week certainly has given the Fed a lot of comfort in being able to lower rates, even though it is coming before the election, which is not typically the case, but the expectations level here that's built into the market is astounding. And you can see here in the circled red oval here that at least August, the number of financial firms that are expecting lower short-term rates is higher than we've ever seen it in this data series. Certainly going back to the beginning of the century here, it's a really, really high number. Expectations are firmly entrenched at this time. Here we have home builder sentiment as we get into some of the housing sector data. We've got home builder sentiment that's kind of languishing. And this data is, I think, is much maybe cyclical, or excuse me, not cyclical, seasonal than it is really of anything. You've got traffic of prospective buyers. We know that that's been low. Overall affordability remains relatively challenged. I talked to a few builders here over the last couple of weeks, and they say exactly the same thing. It's a really kind of a tough market right now. Here we have housing starts. Great work by Charlie Bolello at Creative Planning. It does some great work on this sector. So here's the global financial crisis and the dislocation in the housing sector due to that. And then we had a rise in starts, but we've been struggling to keep up with relative demand. But oddly enough, in this environment where costs are higher and affordability is more challenged, that we're actually at a 50-month low, having been down 1.6% year over year in overall housing starts in the latest data point reading. Here we have single family homes for sale, and this is indeed inherently cyclical. And what we're seeing now is that we've got the highest inventory of homes on the market that we've seen since 2008. So when you have an inventory of homes that's as high as it is now, people looking to downsize, not necessarily looking to take a new mortgage out at a much higher rate, since most people have mortgages. The majority of folks that have mortgages have them at rates lower than 4%. But you do see a lot of inventory on the market, and that's also putting a lid on new home construction as well. Here we have 30-year fixed mortgage rates, which not too long ago were up at 8%. So we basically have dropped 1.5%, 150 basis points, down to around 6.5%. That's not to say that housing affordability is tremendously easy now. It's still relatively tough, but oddly enough, when we did see this rather quick drop in mortgage rates from 7%, that we've seen a spike in refinancings that we haven't seen in quite some time. You've got mortgage credit availability, which we know has been very challenged, but not taking the cue from just a handful of data points. But it does look like over the last probably the last 6 months that credit availability has improved quite a bit. So with lower rates, more credit availability, with this little fishtail kind of like moving higher, if it continues that trend, that should provide increased absorption of some of those units that are on the market and help home builders as well. Switch our attention here to the commercial market. We do know that commercial foreclosures are on the rise, and this first line represents the global financial crisis, and that's pretty well understood. And then those foreclosures went down over time, but ever since the pandemic, we've seen kind of a gradual rise. So this is not something that like happened overnight that we're like, oh my gosh, when did this happen? It's certainly the office properties, which are a component of overall commercial properties. That is an issue. It's maybe 20% of the market, but you've got a lot of other commercial properties, including multifamily residential is considered a commercial property. So, and we do know that a lot of those, properties were financed at much lower rates, and those loans are coming due, and they're going to have to reset at higher rates. And so my own feeling here is that you're, in terms of aggregate dollars, that you're going to have a continued rise in overall foreclosures. And what you hope that doesn't do is put undue stress on the banking market with real estate owned on the books that they're trying to get rid of. Something else that we talk about a lot is the national debt. You can see here, again, from Charlie Bolello, that really over the last 5 years, we've increased our national debt by 60%, and that's to fund a lot of stimulus programs. It's to fund a lot of really, really large budget deficits. And what this is doing is it's driving interest cost higher, which it will eventually help to crowd out government spending. We'll talk about that in a second. But this national debt over the last 5 years, going from basically 22 to 35 trillion, is an amazing rate of growth that is really unprecedented in not only modern times but in the modern world. Here we have that interest cost that I alluded to before, and you can see the tremendous rise in the impact of that. So now, we've eclipsed 1 trillion, and as of July, we're spending about $1.1 trillion just in interest payments. Now, let me make that clear. That's not paying back our debt. That's just paying the interest on the debt. So, and if the Fed doesn't change rates from here, that number is going to balloon in the next year to 1.4 trillion, and that's just an amazing number. But if they engineer 200 basis points or 2 percentage points of interest rate cuts, then guess what? Then that number only goes up to 1.2 trillion, but it's still moving higher. And so we've got a huge reset as some of these older issues sunset, and they're being replaced by new issuance at higher rates. That number is going to continue to go higher. And this is meaningful in the sense that, and it hasn't happened yet, but at some point it will. We have a chart on this, that the increased interest burden is going to crowd out of other government spending. And government spending is one of the components of economic growth. You have overall private sector consumption, you have net investment, which is inventory growth and et cetera. Then you have government spending and you have net trade. And so when government spending gets pinched because of the burden of higher interest costs, then then that has the ramifications of slowing an economy down. Here we have used car prices that are in deceleration. We do know, recall back in late 21 and 22 that it contributed to a lot of inflation. And those used car prices have now been disinflating for a period of time. They're still below, where they were, but they are at a 39-month low, and again, helping to provide more disinflationary impetus into the market. I mentioned this a couple of slides ago. This is the government spending as a percent of GDP. So this is the federal government. This is not state and local, and that's very, very important as well. But you can see here in just really a couple of decades that we've seen a 7 percentage point increase in the amount of government spending as a percent of GDP. And you got to go back to the 50s, and that was 10 percentage points lower. So when the government's spending more on interest costs, it's going to be harder to maintain this number. And it's naturally, I think, going to come down. Now, what you don't want to see is it to go from 27 to 20 in the span of one decade. But I do think that the days of having this outsized spending number are somewhat numbered, just because of the simple aggregate. You can't sustain these deficits as we have been, and spending is out of line. Now, the unfortunate thing is, regardless of what you feel about the election, both sides are of the opinion that we need to continue spending, and I think that's a net problem as we look out onto the longer term horizon. Here's something I showed last week, but I'm going to put it in there again. A week ago Monday, we had a big dislocation in the market, and things, volatility spiked, and I think it's really helpful for us to understand the law of averages here. And so, when you go through long periods where you don't have a lot of volatility, you tend to get complacent, and then when you get the volatility, you're like, well, what just happened? But it's very helpful to kind of remind ourselves that you typically have when you talk about 5% pullbacks, and that's a pretty modest pullback, you tend to have 3 of those every single year. And again, this data goes back to 1930. So this is a lot of data to average, about 3 5% corrections a year. You tend to have a 10% pullback per year. You tend to have a 15% pullback every other year, and then your market cycle, which is kind of defined by like a 20% pullback, happens really once every 3 to 4 years on average. And so if we just keep that in the back of our mind, we profess and preach long-term investment horizons, and and all of our planning and all of our models are driven off of these averages that we understand that they happen. They're natural. These market cycles are natural as well, and and that's just a part of the long-term planning process. Talk about earnings in the S&P 500. You can see, if you go back to the global financial crisis, and we troughed here just in the early part of 2009. And these earnings estimates in aggregate have gone up every year since then, with the exception of the pandemic. And so, this is where we are now in 2024. So for the full year, we're looking for about $240 for the S&P 500. Okay, so this is not a stock. This is earnings for the entire index. And then 2025. We're looking at about 279, 280, and then in 2026, we're looking for about 315. And so as it stands right now, all we're doing in terms of our earnings forecasting is continuing a trend line that's been pretty well established since the global financial crisis. And so, these numbers for 2024 have clearly come down. 2025 is still pretty high. And so I think the risk is that maybe these estimates are a tad high. And so, but we'll have to just wait and see. And we'll certainly know a little bit, we'll have a little bit more insight when we get to the third quarter of 2024, when these companies report and they start issuing their full year guidance for 25. But again, just what we're looking at here is just a basic trend line. We talked a lot about the difference between the published S&P 500 and the S&P 500 equal weighted index, and that's where every constituent within the index has an equal weight in terms of defining what the index level is. And we do know that looking at it at things on that level, this is the operating margin. So we do know that operating margins have come down. This is the pandemic dislocation here, and then this is, we had some entering a period of like margin decline when we had supply chain issues that were wreaking havoc, and overall, inability to pass along price increases that were witnessed in the production chain. But that has largely settled out. Like if you look at at this point here, so we're about a year and a half into this, and it does show a little bit of a rise and fall here, but overall, we're looking at about 13 to 13.5%, and I think the health of the market will depend in some measure on the ability for publicly traded companies in the S&P 500 equal weighted index to pass along those increases to their end customers. But with inflation dropping and input costs kind of moderating somewhat, the hope is that we can maintain operating margins in and around 13% and maintain that level of profitability. So here we have the yield curve. We are looking at continuing to look at an extended period of inversion. This is be like the 10-month less the 3-month rate. And we did almost hit it a couple times. We were really, really close about 2 weeks ago to disinverting, as you will. And this game of trades makes the case that that we haven't seen this environment as long as we have since the Great Depression. And so they're drawing some parallels, and they look at other things that kind of say, well, at this length of inversion, what's the what are the forward earnings are looking like, and multiples, and how how much is the market apt to contract, and so on and so forth. And I'm not saying this time is different. I'm just saying that we did have a really awkward dislocation related to the pandemic and all the economic ramifications. I think we're still building out of this, and now we're getting a point where we're expecting interest rate cuts, and when those materialize, I think this does rectify itself over time. Okay, correlations. When you have stocks and bonds that are very highly correlated, that tends to take away some of the benefits of diversification, right? Because we want to make sure that when one thing goes up, the other, when one thing goes down, the other thing goes up, and vice versa. So you have support when you have market dislocations. Well, we have had correlations that have been pretty high between stocks and bonds, and not just in the U.S., but across the globe here. And the good news, I think, to the degree this is sustainable, is that you've had those correlations break down quite a bit lately, and this is really good for diversification's sake. Here's the S&P 500 third quarter earnings build up, and so you've got stocks that continue to move higher at the same time that you have earnings that have come down a little bit. Now that's not to say that when we get into third quarter earnings season here in really about a month and a half, that these numbers could come up again. But this is just the bottom up earnings per share estimate looking into the next reporting quarter. On this slide, which comes to us by some research by GMO, it is focused on trying to determine how many of the S&P 500 stocks really explain the returns going all the way back to 1995. And their research shows that it really is about anywhere between like 50, 60, 70 stocks max, right? It's not the full 500. So generally speaking, you have, a minority of the stocks in the index that are really responsible for all the returns. And we know, of course, that, that there's about 5 to 7 stocks that have a really unique outsized influence, and that being the Magnificent Seven or the Extraordinary Eight or whatever you want to call them. But, you tend to have a smaller subset of stocks that are really driving overall returns. Here we have the valuation differential between the equal weight and the all-in capitalization weighted S&P 500. So the S&P W represents the equal weight. The SPX is the published S&P 500, which is capitalization weighted, which, as we know, is heavily influenced by those Magnificent Seven stocks. And then, the blue line represents the average discount of the equal weighted price to earnings ratio to the S&P 500. And so that is pretty well established. But then you have these orange bands, which represent standard deviations. So 67% of all of your observations should be in between these. And so when you have outliers like here and what we have right now, it tends to mean revert. So you tend to have more observations within the one standard deviation on either side of the average. And so we have had a near record discount of those equal weighted stocks relative to the overall index. And I think that creates a pocket of value if you're patient and wait for that value disparity to dissipate over time. Something else that I thought was extraordinarily interesting, and again, it's something that it hasn't, it has been going on for a while, but it's accelerated in just the last few years, is the central bank's purchases of gold. And so you can see here in that blue line, which represents gold prices, that actually it has been somewhat influenced by the fact that you've got central banks that are buying gold as in holding in reserve, in some cases to prop up their currencies, and certainly gold is an inherent store of value. We won't get into that very deeply, but the recent activity in gold prices is it's very well explained by the fact that you've got a lot of demand from central banks these days. Here we have the volatility index of stocks, which is that black line. We call it the VIX. The bond index has its own volatility index, but right here we're just talking about the stock volatility. And so, oddly enough, it tends to correlate well with corporate bond spreads. And so the purple line here is the investment grade option adjusted spread. And that's just a fancy word of saying, the spread at which, a bond would need to trade, a corporate bond would need to trade to compensate you for the potential risk of default versus the comparable risk-free treasury, which would be the U.S. Treasury. And so, when you have these spreads, these credit spreads that are dropping, that is basically the market telling you that it has increasing confidence that these bonds will not go into default, and they don't justify that risk premium that you would otherwise ascribe to the bond if you felt like there was a high degree of or a high risk of default. So anyway, so we've got volatility. When volatility is high, the risk of default goes up and those spreads move higher. But when the volatility drops back down, and it has been low, those spreads are likely to continue to drop and provide a good return for investors willing to hold those bonds. Now we'll talk about money flows in the market. So on the left-hand side, we have retail money flows, which have spiked amazingly in a relatively short period of time. We were in kind of a narrow channel for many months this year, as I think investors were kind of sitting on their hands a little bit. But again, these are net retail purchasers. So these are not institutional buyers. These are people like you and me getting in the market, and they're buying. They're not buying ETFs. They're buying, Nvidia. They're buying Tesla. They're buying Apple, and you can see that retail flow has been amazing. And you map that over here to, retail net purchases of U.S. equities. There is a seasonal pattern to this. So this is looking over a period of a year. Blue line represents an average of basically 10 years, and you can see where year to date 2024. Has become a huge outlier. Here we have private clients purchasing more treasuries, so cumulative inflows into treasuries, and we've seen the largest inflow that we've seen in probably about 6-7 years, and in treasuries of all flavors really, and so investors are putting more money into stocks, and they're clearly putting more money into treasuries. And so what that tells me is that there's probably money coming in from the sidelines. It's, AKA like cash sitting in a bank being deployed in the market. So that's a very interesting sign. Now, on the flip side, we have institutional investors through name, and they are decreasing their holdings of equities. So it's a very interesting time. So you tend to think of these as less sophisticated investors over here on the private clients or the retail side, and then you tend to see, institutional investors being, tabbed as the most sophisticated. But there are periods in which, both are wrong, and there are times at which, the market trends are kind of counterintuitive to what, the so-called, institutional investors might think. So wouldn't draw a whole lot into this, but they have been taking profits in equities to a large degree over the last, really over the last month or so. So with domestic purchasers, we have to talk about international and foreign purchasers, and we see that foreign purchasers have really jumped in buying U.S. equities. A lot of that has to do with a strong dollar, translated returns back into your home country. So a lot of attractiveness there, and so you see a lot of purchases of equities. The interesting thing too is that we've also seen continued positive purchases of U.S. Treasuries by foreign buyers, even though it's not as strong as it has been, and maybe some of that drop off there is kind of helped to fuel the equity purchase side. But we see a lot of interest in U.S. assets, risk assets by foreign purchasers. Our last slide here today is, I'll call it the China chart, and really kind of tells us a lot of what we are interested to know about China in one chart here. So we know home prices are in decline. We know new home sales are in decline, and that's obviously a big part of the government mandate, big part of their goal, and a big part of the Chinese economy too. And what we're seeing there is that we're seeing growth in new yuan loans going down. That's in the pink. And so, you've had overall loan growth be pretty stagnant overall. And these are government bonds that are kind of trying to help to fill the void. But if you just look at credit growth, it's completely rolled over. Well, and why is that? Well, you've got net interest margins are at all-time lows for Chinese banks. When they go down, Chinese banks are certainly less inclined to want to make loans, in particular, perhaps riskier loans to help attenuate the problem here and attenuate the problem here. They're just sitting on their hands because they're essentially not making money, and so this is a problem. China's typically solved this by getting the government involved and just like basically printing money. They can do that with an authoritative, centrally managed economy, but obviously the U.S. cannot. So China is going to be kind of struggling for quite some time. That's all we have for the chart pack this week. I hope you've enjoyed it. Have a great week. We'll talk to you again soon.